Hi, my name's Josh Mahony, Chief Market Analyst at Scope Markets. This week has a particular focus on inflation, culminating in Friday's core PCE inflation metric out of the US and the Eurozone CPI number. Well, what could that Eurozone CPI figure do for the Euro and the DAX? That's something we aim to answer in this video. So let's get into it. First and foremost, here's the outlook for markets according to Trading Economics economic calendar. As we can see here, the release of inflation data when it comes to the Eurozone happens over the course of a couple of days. Thursday, we see the likes of Spain and Germany reporting. Now, I've stripped it out just for simplicity because it'd be a pretty long list otherwise, but anyone following these data points will also note that Thursday will have regional breakdowns prior to that German figure. So you'll get a whole host of different German regions announcing. So plenty of figures on Thursday that should also provide some potential volatility as people try to glean the potential implications for the Eurozone figure. But really, that Eurozone figure is going to be absolutely key this week because as we can see at the bottom here, inflation rate expected to drop from 2.6 to 2.2, while the core rate is expected to also drop down to 2.8%. So not necessarily to the same degree, but we're expecting to see some really significant disinflation this week, which could provide the basis for some nice moves in the market. Now, here's the outlook for rates over in the Eurozone. It's worth noting that we are waiting for that pivot from the ECB. And so the question mark here is, when are we going to see it? At what pace are we going to see it? And what would inflation data do to shift this outlook? The breakdown that I have here in terms of inflation for the Eurozone highlights the fact that last time around, it was pretty much flat, minus 0.03 on the monthly figure for July. We can see that 0.54 is stripped out. So that's where the big disinflation comes. We're getting 0.54 taken out. And if we get anything like what we saw last time, 0% essentially, then you're seeing some really significant disinflation that can take us back down towards target. Will it happen this time around? Well, if we look forward and we look from last year at September, October, November, all of them seeing significantly lower rates of inflation on a monthly basis compared to the August number. So this is the occasion where we see the big disinflation move, and it's unlikely to happen in the coming months. And in actual fact, in November, we're likely to see a significant move towards the upside. So we do need to see that disinflation really start to kick in. It's also worth bearing in mind that if you look at what we had been seeing earlier in the year, the February, March, and April figures, you can see here 0.62, 0.76, 0.58, big monthly numbers. That has ended. You can see that the last three figures have been significantly lower. So we appear to have dropped out of that phase and into one that has a much more moderate level of inflation, which should help drive down that CPI number. And that's what we're expecting this time around. As you can see here, the 11-month annualized figure is 2.2, and that's what's expected by markets. So essentially, just give us an average figure from the last 11 months and replace that 0.54 from last year. What do we get? We get 2.2, and that's what markets are expecting. It would take us very close to that 2% marker. Remember, central banks don't necessarily need to see their target hit before they act, because of the fact that ultimately it means they're in that trajectory. If you only wait for that target to be hit to take action, often it will run well beyond that. And that is notable when you look at the beginning of this year, i.e. the February, March, and April figures. Between those, you can see around about near enough 2% inflation, right? So that's where we're going to see some really significant disinflation. If we come into the beginning of next year and we have inflation around the 2% marker, you've got to look at this and say, well, once February, March, and April are all stripped out, you're going to be at closer to 0% than you are 2%. So then you start talking about disinflation, you're talking about negative inflation, deflation, and that, of course, would ramp up the possibility of more dramatic action from the ECB. So certainly they are in a position to move according to this 2.2% that looks likely this time around. Now, on the core side of things, it's not necessarily as impressive. 2.85, the figure. Some of these numbers seem to be sort of crossed out a little bit, but nonetheless, what we're looking at here is a continuation of the deflation disinflation trend that has been playing out. But we have seen this sort of flatlining. So we'll be happy to see this continue to move towards the downside. You can see 2.73 expected on the 11-month annualized figure. If we're looking at what's getting stripped out, you can see that the big inflation really happened this year. It didn't really happen last year. The figure that's getting stripped out is 0.34. And that's why you can see that markets are essentially only looking for a 0.1% decline, because there's not really much room for maneuver. Whereas when you come back to the beginning of next year, like I said, if you're anywhere near 2% by the beginning of next year, then you're in for a surprise, because 0.67, 1.1, 0.7, those three stripped out, that's going to really drive down core inflation in a meaningful manner. And the ECB will be aware of this. So if we get anywhere near that sort of mid 2% mark, I think they'll be happy, quite frankly, because they know they've got these really significant numbers coming out at the beginning of next year. In terms of the market outlook for the ECB, well, we've essentially got a 100% chance of a cut according to the Icon platform. That in September is pretty much all attributed to a 25 basis points move. And then we're looking beyond that at a potential 25 basis points move, so 62% chance of another 25 basis point cut in October. Beyond that, another 25 in December. And then the most likely is another 25. So market's really expecting 25 basis point cuts each time around. What could shift this sentiment? Well, we could see particularly weak data coming out, and certainly the German economy has been the one area that has been providing us with the basis for that to possibly happen. And another would be inflation coming in well below expectations, or as we've seen here, right? Last month, inflation on a monthly basis came in at 0%. And the figure that's getting stripped out this time around is 0.54, right? And we're at 2.6. So there is a potential for us to get down to 2%. And in which case you could look at that and say, well, the ECB might start to cut by 50 basis points, because they start to realize that soon enough they'll be in a position where once we roll into 2025, they're going to see inflation dropping back well below 1%. And that's not necessarily a position they want to be in either, right? So we could see that if we saw another monthly reading like last month. It's not necessarily what markets are expecting, but that's the kind of thing that could shift sentiment around the ECB action. What would happen if we saw a figure above expectations, a strong inflation figure? Then maybe you see them sort of pulling back a little bit in terms of expectations for the ECB action. At the moment, they seem pretty confident that we're going to see a 25 basis point cut at each meeting. Maybe that would shift if we saw a higher than expected figure. This is let me just put this in full screen. This is a chart that I've got here, Euro Sterling charted against the 10-year yield for the Eurozone and the 10-year yield for the UK. And so what we're looking at here is the possibility for weakness in terms of yields in the Eurozone. Now, we did see a pop around what's happened in France, but we're seeing it starting to roll over, and we're seeing Euro Sterling really leading the way on that. But certainly if we see weak inflation data coming out from the Eurozone, in particular, I would say the core figure, then we're looking at a continuation of that Euro Sterling move. Now, let me just bring that up in the sort of live environment here. So like we're saying, we've got this close correlation. Every once in a while, you do sort of stray away from that. But more recently, we've seen that surge. We've seen the rolling over in terms of Euro Sterling, and the sort of topping out here in terms of the yields here. And so if we were to see a move that really ramps up confidence in those ECB cuts, or potentially points towards a 50 basis point cut from the ECB, then you could start to see further downside here for the EU 10-year versus the UK 10-year. And that would point towards a continuation of the weakness in terms of Euro Sterling. Let me just bring this in an hourly time frame and show you we have got a very nice trend within this on an hourly time frame. So what we're looking for here is you're looking for the creation of lower highs and lower lows. You can see here we created that push higher, and then we ultimately broke down. So there's different ways of looking at it. This will be the 4-hour chart. So on this 4-hour chart, we'll be able to see some of the levels. As we can see here, these are the sort of intraday levels, and then we've got the sort of wider levels as well here. So for the time being, we're looking for a continuation of the intraday trend. Let's just see if there's trendline resistance up top. Not perfect because we didn't hit that third touch, but it gives you a good idea that maybe at some point soon, maybe it could be around this inflation gauge. If we see it coming in stronger than expected, maybe we start to see a push back up into this area. And, you know, like we see here, we see the lower highs and lower lows. Then we rebound into the wider retracement of that move and then sell off. Then we're seeing a rebound into the retracement of the wider move and sell off. So we haven't seen that for a while. That could come into play. But until we see a breakup through that 0.846, there's a good chance that we see a continuation of this intraday downtrend that has been playing out for euro sterling. In terms of the DAX has been doing very well, despite the fact that there's plenty of questions around the German economy. We've come back into trendline resistance here. So quite what we're going to do here between trendline resistance and 187.83 swing high that was set back here in mid-July. If we break through that level, then we're looking for that push up into record highs here for the DAX. But certainly for the near-term perspective, a very clear uptrend in play with a breakdown through your near-term swing low of 185.48 required to negate the intraday uptrend that currently plays out for the DAX or the German index. And certainly if we do see that disinflation, that strong disinflation that's expected for the headline figure, that could once again really hammer home the idea that the ECB is in a very good position to cut interest rates in September.